All right, we're going to do exercise 15.5. To do that one, it's exactly the same as 15.3 and 4, which we did last time. So I'm going to go ahead and share my screen. And I'm going to go back and look at exercise 15.4, which is one that we did last time. And literally the only difference, let me go ahead and, yeah. So the only difference here is that instead of us leasing the asset, like instead of it being a direct financing lease, it's going to be a sales type lease. But I think I want to go ahead and just work it from scratch again, just to make sure you're understanding it, okay? So let's go ahead and just start here. So this is exercise 13.5. So on June 30th, 2018, Georgia Atlantic leased warehouse equipment from builders. The lease agreement calls for semi-annual, so maybe I should first identify that this is E15. Semi-annual payments of, that's not how you spell payments, of $562,907, 3 years, which is 6 semi-annual payments. Okay, what else? On June 30th and December 31. So it started on June 30th. First payment due immediately on June 30th. Borrowing rate is 10%. And that's the same rate as what builders would use to calculate the lease payments. We manufactured the equipment. Builders manufactured the equipment. At a cost of $2.5 million. Okay, so sure, first it says to determine the price at which builders is selling the equipment. So the present value of the minimum lease payments. And remember, this is the one where it said do it to the nearest like 1,000 or whatever. And we're not going to do that. We're going to do it with the right number. So the present value of the minimum lease payments. That's the first thing we're supposed to find. So the rate is 10%, but it's semi-annual, so I divide by 2. The number of years is 3 times 2, and those payments are $562,907, but the first payment is immediate. So our number there is $2,999,999.72. So then it says what amount would be on the balance sheet for this. So on December 31 of 18. So what amount on balance sheet and income statement? So let's just do balance sheet first. For builders. Now, builders is the person who made it, okay? So let's keep track of who we have here. We have Georgia Pacific. Nope, Georgia Atlantic. I was close. Guess I have Coke on the mind. So Georgia Atlantic is the lessee, and builders is the lessor. And this is a sales type lease because we built the asset for 2.5 and now we're selling it for 3. So let's go ahead and build our amortization table real quick. So payment date. So this one's date, this one's interest, this one's principal. And this is the outstanding balance. I missed a payment. I was like, I know I'm missing one. So let's put principal right there. Okay, so when I start this little booger, I'm going to start it at the present value of the minimum lease payments. The first payment is due immediately on 6/30 of 18, and then 12/31/18, and then 6/30/19, and so on. So I need 3 more. All right, we should be done with this little booger on 12/31/10. My payments are 562,907. The first payment will involve no interest, so all principal. And then our balance goes down to that. Our payment will stay consistent the whole way down. Oops. I was linked to a cell up there. Interest will be on the outstanding balance, 10% times half a year. So the difference between the payment and the interest goes to principal. My outstanding balance drops down, double click down. So just to make sure we're okay. Interest is based on the outstanding balance at 10% for half a year. Principal is the difference between your payment and your interest. Every payment you make, some is interest, some is principal, and then it knocks off the outstanding balance. So let's take those and skinny plus down, hitting 0. I do want this to be prettier, so I'll hit the comma button. So we want to know what amount is on the balance sheet for builders, okay? And so as of 12/31/18. So if we were to look at the journal entries for builders, they would do a journal entry on 6/30/18 to show that they sold the asset. So they would do lease receivable, revenue, and then they would do cost of goods sold, and the leased asset, which is inventory, would leave the building. So lease receivable would be the 2,999,999,999. And the cost of the good that was sold is 2,500. And then on 6/30/18, we would receive our first payment, cash, lease receivable, and that would be 562,907. And then on 12/31/18, we would receive our next payment, 562. Some of it would be interest, and some of it would just be the receivable. The interest would be that little feller, and the principal would be that little feller. So the question for number 2 said, what would show up on the balance sheet? So on the balance sheet, we would show lease receivable with a balance of, it started off with this, but then we reduced it by this and this, which should be the number from the table up above, 1,996,040,36. This is exactly the same as the problem I worked last time, but that's okay. I'm not judging. I'm not judging myself for not having assigned it to the previous homework problem, but whatever. Okay, and so then on the income statement, that's number 3. Number 3, what says what goes on the income statement. And this is the only difference between problem exercise 15, 4, and 5. Because on the income statement, we're going to actually have revenue and COGS. So the revenue is here, and the cost of goods sold is here, showing some gross profit, right? And then also we'll have some interest revenue. My interest revenue for 2018 was just at 121. So let me look, what amounts of the lease would be on the income statement for the year ended, ignoring taxes. Okay, so that would be it. So again, we're looking at it from the side of the lessor on this problem, and that's why we have receivables and revenue as opposed to payables and expenses. So stop my share. All right, thank you guys.